and they're right, but we have here a line in the sand here, a pivot point. This is the point of the 2015 low in the ratio, and we're about to break through it again. We have knocked on this number many times. 1, 2, 3, 4, 5, 6 is the 7th time since 2022, and we're going to break through. And once we break through, I think we're going to be in a multi-year, if the monetary system lasts out, it will be in a multi-something. It'll be a long time where gold is going to outperform stocks, and once that happens, more and more people are going to pile in.
Endgame investor Rafi Farber highlights that, despite gold having doubled since its 2015 low, it has trailed behind the S&P 500, keeping most mainstream investors' attention fixed on equities. However, the gold-to-S&P ratio indicates this trend might soon pivot, as gold nears a crucial resistance level set back in 2015, potentially signaling a shift in favor of the precious metal. With Dhanteras around the corner, demand for gold is accelerating, pushing prices near all-time highs. Since Diwali, gold has emerged as one of the top-performing asset classes, delivering a robust 32% return compared to the S&P BSE Sensex's 25%. In the face of global economic uncertainties and geopolitical tensions, gold's steady performance reinforces its status as a safe haven asset, with silver also gaining ground with impressive 35% returns in the same timeframe. In 2024, gold climbed over 33%, outpacing the S&P 500 and leading once skeptical analysts to recommend holding bullion. Farber suggests that if gold can break through this key level, it could mark the beginning of a multi-year period where gold outperforms stocks, drawing more investors to consider gold as a hedge against diminishing real returns in equity-based portfolios. October saw gold hit a record high of $2,800, with a minor $50 retreat due to profit-taking, closing the month with a 3.4% gain. This sustained strength in gold prices, despite a stronger US dollar and rising treasury yields, underscores its appeal as a stable investment amid economic volatility. Stay tuned for our in-depth analysis. Make sure you subscribe and enable notifications to stay updated on future content. Your support means a lot to us.
Why nobody cares about the gold run and why that changes soon. This is a chart of the gold to S&P 500 ratio. So you see here a few things I wanted to point out. We see a head and shoulders bottom here with the head at 2022 over here where I'm circling and the shoulders at 2018 and 2024. Head and shoulders bottoming pattern, and we have broken through both the 50-week moving average and the 200-week moving average, and we have a golden cross, which I think I pointed out last week. The blue line, the 50-week moving average, is crossed above the 200-week moving average, excluding 2020. This is the first time that this has happened since 2001. I pointed that out last week, but the point here is that the reason that nobody cares about the gold run, by nobody I mean the mainstream, they don't care about the gold run, is because since 2015, look here, 2015, I have this highlighted. The low in 2015, the ratio was 0.503. We are now at 0.44. So despite gold's bull market since 2015, at 2015 it was at 1054 low, I think, and now it is at 2760. So it is more than doubled. Gold is more than doubled, but it's still underperformed the S&P 500 despite that. And it's very frustrating for gold bugs and the stock stackers. Can you stack stocks? Well, let's just call them the bubble chasers. They are saying, and rightfully, that the stock market, S&P 500, has still outperformed gold since then. And they're right, but we have here a line in the sand here, a pivot point. This is the point of the 2015 low in the ratio, and we're about to break through it again. We have knocked on this number many times. 1, 2, 3, 4, 5, 6 is the 7th time since 2022, and we're going to break through. And once we break through, I think we're going to be in a multi-year, if the monetary system lasts out, it will be in a multi-something. It'll be a long time where gold is going to outperform stocks. And once that happens, more and more people are going to pile in as they realize that in real terms, their portfolios are evaporating, even if their dollar amounts are rising, because their gold ounce amounts.
Farber suggests that if the Federal Reserve resumes money printing to counter falling reserves, silver could see a substantial rally, posing a risk for stock investors facing potential real value declines. Traditionally, silver trails gold in the early phases of a precious metals bull market. During the last major bull run, silver skyrocketed by 1,000%, hitting a peak of $50 per ounce in April 2011. This year, silver has already climbed over 40% and recently tested a key 12-year resistance level at $35. The recent liquidation of short and medium-term bullish positions around the $32 to $35 mark could create attractive entry points for long-term buyers, potentially setting silver on a trajectory to break its all-time high, possibly exceeding $50 by early 2025.
Short-term silver technical picture is this. Here is the trend line since August when we were at 26. Now we're at 32.80. We're still above that trend line. We would tag it here at about 32. We're also at a support zone, which we hit in September and October as resistance, and also in May as resistance of about 32.80. We'll see if we bounce here. Silver can be very volatile, and once the Fed turns, once the reverse repos run out and the reserves go down and then they have to print more, silver is going to turn around violently, and it's going to be scary for stock market stackers because they're going to start losing real value quickly. The bigger silver picture here, technically, is that we have a line. I forgot to draw it in here. I did draw it in, but it's not here. I guess I put the wrong picture in. But we're at this resistance line of 35. You can see it's the same area as was resistance from 2011 to 2013 before the bear market really started. So we're at that point here. So the fact that this is resistance again is not particularly surprising to expect to slice through this very old resistance all the way back from 2011 is pipe dream thinking, but we will slice through it. It's going to take a little bit longer, maybe a few weeks, maybe a month or two. Maybe it'll be timed with the Fed turning around after the next banking crisis. We'll see, but it's close at hand. QT has slowed by 37% since June. You can see here the numbers that I put in. At December, the balance sheet was at 7.7 trillion, and 22 weeks later, when the Fed started to slow down QT, it was at 7.284 trillion, and now it's at 7.013 trillion. So the rate of decline in the balance sheet is down by about 37% from these 22 weeks to those 22 weeks. They have slowed it down, but they have not slowed down the percentage of dollars that are being backed by literally nothing, and that is the back-end mechanism of what hyperinflation actually is, when the assets of a central bank are worthless that back the liabilities, which is the currency. Bank reserves are steady. These are the reserves, the extra dollars, that if they fall below 3 trillion, we should be at the next banking crisis. You can see here the red lines, all point to month ends when bank reserves tend to fall. And they probably will fall this month too. The numbers will be in at the end of the month. This data is good until October 30th for Wednesday. And it could be a very violent drop given how much money has been vacuumed out of the system thanks to those treasury auctions that cleared last week.
The current landscape